We are kicking off today's deep dive with the story that is casting the longest shadow over this Friday's session: President Trump's renewed and pointed attack on Federal Reserve interest rate policy. Trump declared publicly that the United States should be paying much less in borrowing costs, leveling accusations that political motives are behind the Fed's current stance. This is not a casual offhand remark. It is a deliberate escalation of executive pressure on an institution that markets have long priced as independent. With equities already sliding and bond yields climbing, the timing could not be more consequential for how the rest of this session and this month unfolds. Here are the hard numbers framing Trump's attack. The 10-year Treasury yield is trading at 4.70%, up 0.92% on the session, a meaningful intraday move that tells you bond markets are repricing risk right now, not waiting. The 5-year yield sits at 4.39%, and even the 13-week T-bill has ticked up to 3.70%. Meanwhile, equities are broadly in the red. The S&P 500 is off 0.84%, the Dow falling 1.27%, and small caps via the Russell 2000 declining 1.34%. This is a coordinated risk-off move, not a single asset blip. The surface story is Trump wants lower rates. The deeper story is what happens to Fed credibility if markets begin pricing in political capitulation. Central bank independence is the foundational assumption behind every discount rate model on Wall Street. The moment that assumption cracks, long-duration assets get repriced across the board. Trump's framing that the Fed is acting from political motives rather than economic data is precisely the kind of narrative that can shift institutional confidence. The 10-year yield at 4.70% already reflects significant tightening. If traders begin to doubt the Fed will hold that line, you get a volatile two-sided market where both bonds and equities face uncertainty simultaneously. Let's get specific about who is exposed right now. Long-term treasuries and TLH, the long and intermediate treasury ETFs, are caught in a crossfire. They rally if the Fed pivots, but fall further if yields move substantially higher. Financials face margin compression in a rate cut scenario. Think JPMorgan, Bank of America, Wells Fargo, and the broader the financial sector universe. Technology names like NVIDIA, Microsoft, and the Nasdaq-100 complex benefit from lower discount rates, but are currently facing the headwind of that policy uncertainty premium. Small caps in the Russell 2000 are especially sensitive, down 1.34% today, because they carry more floating rate debt. On the safe haven side, gold futures are surging as investors hedge the policy noise. The single most important level to monitor from here is the 10-year Treasury yield at 4.70%. A break above 5.0% would signal that the Fed is not only holding firm, but that bond markets are pricing in further tightening. A deeply hawkish signal that would accelerate the equity sell-off and likely push long-term treasuries meaningfully lower. Conversely, a drop below 4.50% on the 10-year would suggest the market is beginning to price in a dovish pivot, which would compress spreads and ignite a rally in rate-sensitive growth stocks. On equities, watch S&P 500 support in lower ranges. The VIX remains relatively contained, but any Fed communication, scheduled speeches, minutes, or surprise statements becomes a market-moving catalyst immediately. Here is the bottom line for traders and investors heading into the weekend. Trump's Fed attacks inject genuine policy uncertainty into a market that is already showing stress. The Dow is down 1.27%, small caps are down 1.34%, and the 10-year yield is climbing to 4.70%, all on the same session. This is not noise you can fade easily. If the Fed signals any capitulation, expect a sharp bond rally and a violent equity squeeze higher. If the Fed holds, which is the higher probability scenario based on current guidance, the mild risk-off tone stays in place and gold moves upward as investors seek safety. That is the full story driving markets this Friday. Stay disciplined, watch the yield, and we'll see you in the next one. If this breakdown gave you an edge today, subscribe right now and hit the notification bell. We publish every market day, so you are always ahead of the open. Share this with one trader who needs to understand the Fed story this weekend. See you Monday.